My name's Charlie Viola. I'm one of the founders of Viola Private Wealth. We manage about just over $3 billion of assets for high net wealth individuals, private clients, some small family offices, some small institutional investors. We manage money across all of the asset classes. We're pretty well known in the market for taking a big allocation to private markets. Public markets are still really important. They still punch out income. They still, sort of generate good earnings growth for clients. But we're a big believer in that private market space. As we started to get bigger and bigger clients, and as we started to get more sophisticated clients, what we probably found is there's only so many CBA and BHP shares that you can buy for them. These guys were looking for exposures that were not correlated to things that they did every day. We had lots of investment bankers, but also they wanted to see different and interesting investments. In private equity and VC especially, where in those funds where you're fundamentally backing the jockey, you're fundamentally backing the manager's ability to find opportunities, work through those opportunities, and then get them to an exit. Manager selection becomes so incredibly important. What you've got is you've got some really smart people who have gone and invested in what they think are really good quality businesses with a business plan to an outcome, and everything else is just noise until the outcome actually occurs. So we like that. We work really hard to educate the clients to stop comparing your kind of point-to-point PE and VC returns with the day-to-day mark-to-market returns that you're getting on equity markets. We take an endowment style view. So we take a Harvard, Yale type view in terms of how we build out portfolios. If you look at how those major endowment portfolios have been invested over time, 45% of it is in private equity and VC, because they take a long-term view in terms of good quality businesses that will grow over time. We want them to think about that part of their portfolio as producing the best return in the portfolio over a long term. Our private market allocation is, depending upon the client, will be anywhere from sort of 35 to 45% across all the various different types of private market allocations. So private debt, private credit, infrastructure, VC, PE. PE and VC will be anywhere from sort of 8 to 15% of a total client portfolio. So what we've probably seen over the last 10 years or so with groups like VentureCrowd and iPartners is that continued democratization of the private market space, where you've got these guys going out and finding really good, interesting opportunities and allowing investors for really small amounts of money to take exposure to them. Once upon a time, you just weren't able to do that. These platforms now give people the opportunity to go and execute on those things with small amounts. It's simple, and they can almost build up their own portfolios of sort of single investment opportunities. It's fantastic. It's probably almost like, if we think about the fact that 25 years ago in Australia we started having managed funds, which gave people an opportunity to kind of invest in well-managed kind of diverse funds of domestic and global equities. These platforms now give people the opportunity to almost do the same thing but in venture, which generally speaking wasn't available to the everyday person previously. People want instant access, instant investment, lots of information, ability to log in on their phone, and you're giving them all of that. We take the view that we think returns will be better over the next 15 or 20 years because we've got a much larger breadth of assets to now access.